Imagine leaving $5,000 in crisp $100 bills just sitting on a public park bench. You just set the money down, turn your back, walk away, and go about your entire year never looking back.
Yeah, no one listening to this deep dive would ever do that. I mean, it sounds completely absurd.
It sounds insane, but the wild part is, by keeping your cash parked in a standard traditional bank account right now, millions of Americans are doing the exact mathematical equivalent, and you don't even realize the money is gone.
Because it vanishes without a trace. It's
Ugh.
this invisible drain. We're conditioned to think that losing thousands of dollars requires some catastrophic event. Like we picture a stock market crash wiping out a 401k.
Right, or buying a house right before a bubble bursts, or, I don't know, taking a massive risk on some speculative crypto thing that just goes to zero.
But the reality is infinitely more mundane. I mean, it is not a market shock. It's the boring, everyday savings account you've probably had since you were 20 years old.
I kind of want to break down the mechanics of this immediately because it sounds counterintuitive to, well, literally everything we are taught about personal finance. We're told a savings account is a vault.
A total fortress.
Yeah, a fortress. The balance never goes down. You log into your banking app, you look at your emergency fund, and the number is the exact same as it was yesterday. So if the principal isn't going down, how are people bleeding thousands of dollars?
Well, you're bleeding thousands of dollars because of the massive chasm between what the macroeconomic environment dictates your money is worth and what legacy financial institutions are actually paying you for the privilege of holding it.
Wait, paying for the privilege?
Yeah. Let's look at the baseline reality here. According to the Federal Deposit Insurance Corporation data, the national average savings account pays an annual percentage yield, an APY, of roughly 0.38%.
0.38%.
It's practically a rounding error. And this is the reward people get for doing the responsible thing. You grind away at your job, you pay your taxes, handle your mortgage, and you meticulously carve out a portion of your income to build a safety net.
And you park it in that legacy bank and they hand you 0.38%, which, I mean, if the average is 0.38%, I think the immediate assumption most people make is just that interest rates must be universally low everywhere.
Sure, they think it's the same across the board.
Right. Like, if every bank is paying a fraction of a percent, you might think, there's no problem to solve here. You can't squeeze water from a stone.
And that assumption is the core of the whole problem. We are not in a zero interest rate environment anymore. The Federal Reserve aggressively hiked the federal funds rate to combat inflation, so capital has a real cost again.
So money is actually worth something to these banks now.
It is. But while traditional legacy banks are keeping their yields anchored to the floor at 0.38%, a parallel ecosystem of digital and online banks has emerged, and they are paying 4%. With some promotional yields hitting 4.5 or even 5%.
Wait, hold on. If the benchmark rate set by the Fed is elevated, why are the massive brick-and-mortar banks allowed to just ignore it and pay 0.38%? How does a multi-trillion-dollar institution justify paying a tenth of the market rate?
They justify it because they can get away with it. There's this metric in banking called deposit beta. It basically measures how much a bank changes the interest rates it pays depositors when the Federal Reserve changes its interest rates.
Okay, so like a responsiveness score?
Basically, yeah. For digital banks, the deposit beta is extremely high. If the Fed raises rates by 1%, the digital bank might raise its yield by 0.8% to attract your money. But for legacy banks, the deposit beta is essentially zero.
So the Fed raises rates, the legacy bank charges higher interest on the mortgages they issue to people.
But they do not pass a single dime of that yield back to the savings account holder. They keep the spread.
So this isn't just about small differences in profit margins. This is like a structural pricing failure in the consumer market. I mean, 0.38% versus 4.5% isn't a competitive variation. It's an entirely different financial universe.
It really is.
But percentages can feel abstract. Let's run the actual math to show you the raw dollar impact of sitting in one of these legacy accounts.
Let's run a scenario with a higher balance first to see the extreme end of the opportunity cost. So imagine you're holding $120,000 in liquid cash.
Okay, $120,000. So maybe a business owner's operating reserve, or the proceeds from selling a starter home while waiting to buy a new one, or just a really aggressive emergency fund.
Yeah, any of those. If you keep that $120,000 in the traditional bank paying 0.38% over the course of an entire year, that money generates about $456.
$456 on 120 grand. That doesn't even come close to covering the cost of inflation.
Not even close.
I mean, at a standard 2 or 3% inflation rate, the purchasing power of that $120,000 is eroding by thousands of dollars, and the bank is throwing you a $450 life preserver while you drown.
It's a guaranteed loss of real purchasing power. Now let's look at the alternative. You take that exact same $120,000. You don't add any new capital. You don't take on any stock market risk.
No volatile crypto.
Right. You simply move the capital to an insured high-yield account paying, say, 4.38%. Over that same 12-month period, the account generates $5,256.
Oh, wow. So the gap there is $4,800, almost $5,000 in pure, unadulterated passive income.
Yeah.
That is the park bench analogy in real life. By leaving the money at the old bank, you are actively choosing to leave $5,000 sitting on a table, and you aren't being compensated for that loss with, like, better service or safer structural guarantees.
They're getting nothing in return for that massive haircut. It is the equivalent of a landlord deciding to rent out a luxury apartment for $50 a month when the market rate is $5,000.
That's a crazy way to think about it. But the $120,000 example is kind of a sledgehammer to the face. Let's scale it down to an everyday reality, because most people do not have 6 figures of liquidity. A standard financial goal is 3 to 6 months of living expenses. So let's look at a $25,000 emergency fund.
The math scales proportionally, and the proportional loss is just as devastating to a household budget. So a $25,000 balance at 0.38% yields $95 for the year. It's essentially stagnant.
Just 95 bucks.
Yeah. Move that same $25,000 to a 4% high-yield account, and it generates $1,000.
Wow. So we're talking about a $900 swing. For a middle-class family, $900 is not trivial at all. That is the difference between covering a sudden car repair in cash versus putting it on a credit card at 24% interest and starting a whole debt spiral.
Yeah. That $900 is multiple months of utility bills. It's groceries. It's a buffer.
And the most frustrating part is that the money was already generated by your labor. You worked for it, you saved it, and the bank is just quietly siphoning off the yield.
Siphoning is the perfect word. And to understand why this happens, we really have to pull back the curtain on the business model of banking. We have to kill the illusion of the giant steel vault.
Right, because I think the average depositor fundamentally misunderstands what a bank actually does. We still picture like a Scrooge McDuck vault, where our specific dollar bills are stacked in a little safety deposit box waiting for us to come back and claim them.
Which couldn't be further from the truth. In reality, your money doesn't sit idle for a single second. The moment your direct deposit clears, the bank treats your money as raw material.
Raw material.
Yeah, they operate on a fractional reserve system.
Yeah.
So they are required to keep a small percentage of total deposits on hand to handle, daily withdrawals. But the vast majority of that capital is immediately deployed. They use your money to issue 30-year mortgages, fund auto loans, provide credit lines to corporations, and back high-interest credit cards.
Oh, I see. So the bank is just an intermediary. They are buying money from me, the depositor, at a wholesale rate, and then selling it to my neighbor at a retail rate when he needs a mortgage.
That's it. And the spread between those two rates is what drives the entire global financial system. It's called the net interest margin.
Net interest margin.
Yeah. If a bank is charging an average of 7% on the loans they issue, but they only pay out 0.38% to the depositors funding those loans, they're capturing an immense spread. The net interest margin is the lifeblood of a legacy bank.
Okay, but if I am the raw material supplier in this equation, right? If I'm providing the capital they need to make those lucrative loans, why am I accepting 0.38%? Why don't the legacy banks have to bid up the price they pay for my money? I mean, in any other industry, if demand for raw materials goes up, the price goes up.
Well, the difference comes down to customer acquisition and legacy infrastructure. Just think about the physical footprint of a massive national bank. They have 10,000 branches. They occupy prime commercial real estate in the center of Manhattan, Chicago, Los Angeles.
Oh, sure.
They pay utility bills on thousands of buildings. They have hundreds of thousands of employees. Tellers, security guards, regional managers, compliance officers.
So the overhead is astronomical. They have to maintain the marble floors, the drive-through lanes, ATMs on every corner, and these massive corporate hierarchies.
Right. That overhead requires a huge portion of the net interest margin just to keep the lights on. But more importantly, those physical branches serve a purpose. They capture deposits through sheer geographic presence.
Because it's convenient.
Exactly. If people open an account because the branch is across the street from their office. Once the money is there, the legacy bank knows the customer is highly unlikely to move it. They have a captive audience. So they don't need to offer 4% to get capital because they already have trillions of dollars of lazy deposits just sitting in their accounts.
Which brings us to the disruptors, the online banks, the digital credit unions, these fintech platforms offering the 4 or 5% yields. I have to assume their cost structure looks entirely different.
It's completely inverted. An online bank has 0 physical branches. They have 0 tellers. Their entire consumer interface is a cloud-native mobile app.
Right.
Their customer service is often handled through centralized call centers or AI chatbots. Their real estate footprint is maybe 1 or 2 corporate offices.
So because they don't have to pay for 10,000 marble lobbies, their operational costs are a fraction of the legacy banks. But instead of just hoarding that extra margin as corporate profit, they use it offensively.
They use the yield as their primary customer acquisition tool. A digital bank cannot rely on you walking past their building on your lunch break. They have to convince you to actively transfer your funds.
And the only way to induce that behavior is to offer a significantly higher return.
Yeah, they take the capital they would have spent on physical branches and hand it directly to the depositor in the form of a 4.5% APY. It's a highly efficient pricing strategy.
So the logic holds up, the economics make sense, but I know exactly what a skeptical listener is thinking right now, because it is the exact same thing my grandfather would say. If something sounds too good to be true, there is a catch. If the massive legacy banks are paying pennies, and some app on my phone with a neon logo is offering me $5,000 a year in free money, human instinct screams that this is a trap.
The instinct is totally natural. I mean, we associate higher yields with higher risk. In the stock market, if you want a 10% return, you have to buy volatile equities. If you settle for a 3% return, you buy stable treasury bonds.
Right, so the immediate fear is that the online bank is taking my emergency fund and gambling it on collateralized debt obligations, or throwing it into an unregulated crypto lending pool, or making highly speculative commercial real estate loans to generate that 4% yield. Like, what happens if they make a bad bet and the bank collapses?
This is the most crucial distinction to understand. The yield on these specific accounts is not a risk premium. Your money is not being funneled into shadow banking to generate that return. The bedrock of this entire strategy is federal insurance. You must ensure the institution carries FDIC insurance for banks or NCUA insurance for credit unions.
The Federal Deposit Insurance Corporation. We see the gold sticker on the door of the bank, but I really don't think most people actually know how the mechanics of that insurance work, especially when the door is just a website.
Well, the FDIC was created in the aftermath of the Great Depression to stop bank runs. It's an independent agency of the United States government. They maintain the Deposit Insurance Fund, which is backed by the full faith and credit of the U.S. government. The standard insurance amount is up to $250,000 per depositor per insured bank for each account ownership category.
Let's define the limits clearly here. If I have an individual high-yield savings account, it is protected up to $250,000. But what if a married couple is listening? Do they share that limit?
No, it is per ownership category. A joint account is a different ownership category. So if a married couple opens a joint high-yield savings account, they're insured up to $500,000 because there are 2 depositors.
Oh, I see.
Yeah, and if you have individual accounts and joint accounts at the same institution, the coverage stacks mathematically based on the FDIC rules.
So the federal government is guaranteeing that even if the digital bank completely mismanages its balance sheet, goes totally insolvent, and the CEO flees the country, the depositor will not lose a single penny up to those limits. The government steps in and makes you whole.
That is the guarantee. And the vital takeaway here is that the risk profile of your cash is identical, whether you are earning 0.38% at a legacy bank or 4.5% at a digital bank. Both are FDIC insured.
So the underlying asset, your cash, carries effectively 0 risk up to the insurance threshold. The extra yield is just a structural byproduct of the bank's low overhead, not a reward for you taking on systemic risk.
Correct.
Okay, but if the risk is 0 and the yield is a massive multiple of the legacy banks, the logical extreme is that we should drain every single checking and savings account at our traditional banks right this second and move it all to the high-yield ecosystem. Just initiate a wire transfer for every dollar to our name.
I strongly advise against that. Moving everything indiscriminately conflates the purpose of different financial tools. You really have to separate your operational capital from your stored capital.
Operational versus stored. Okay, so my checking account is my operational capital. It earns 0%, and frankly, I don't expect it to.
Nor should you. A checking account is a transaction engine. It's the landing pad for your employer's direct deposit. It is the hub that your debit card draws from. It pays your mortgage, your auto-pay utility bills, your Venmo transactions.
The velocity of money in a checking account is incredibly high. Capital is flowing in and out multiple times a week.
And because the balance is constantly fluctuating, the bank cannot reliably lend that money out on a 30-year time frame. The duration mismatch would be a disaster. Therefore, they cannot pay you a yield on it.
Oh, that makes total sense. For operational capital, your priority is utility, not yield. You need immediate clearing times, lack of transaction limits, integration with payment networks, and maybe physical ATM access.
Precisely. But stored capital is a completely different asset class.
So stored capital is your emergency fund, your tax reserve, the down payment for a house you plan to buy in 2 years. This is money that sits statically on the balance sheet.
Right. It is not subjected to daily debit card swipes. Because it's static, it suffers the most from inflation. That is the capital you must deploy into high-yield vehicles.
And when we talk about these vehicles, our sources for this deep dive highlight 3 distinct tools: the high-yield savings account, the money market account, and the certificate of deposit. If I am looking to optimize my stored capital, how do I differentiate between these 3?
Well, it fundamentally comes down to your liquidity timeline. The high-yield savings account, the HYSA, is the baseline. It functions exactly like your legacy savings account, just with a better APY. Your cash remains completely liquid.
Meaning I can get it whenever I want.
Right, you can initiate a transfer back to your checking account at any time. It usually takes 1 to 3 business days for the ACH transfer to clear. This is the absolute best place for a true emergency fund, because you need the capital to be accessible, but not so accessible that you accidentally spend it on daily expenses.
What about the money market account? Is that just a rebranded savings account?
A money market account, or MMA, is kind of a hybrid. It offers competitive yields similar to a high-yield savings account, but it maintains some operational functionality. MMAs often come with the ability to write physical checks directly against the balance, or they provide a dedicated debit card.
So if I am a homeowner building a massive renovation fund, and I know I will eventually need to hand a $20,000 physical check to a contractor, an MMA allows me to generate high yield on that capital right up until the second I hand the check over, without having to route it back through a checking account first.
Exactly. It removes a layer of friction for large, bulk expenditures. Then we have the third option, the certificate of deposit, or CD. A CD introduces a completely different dynamic, duration lock-in.
Right, CDs are time-bound contracts. You are promising the bank that you will not touch the money for a set period.
You agree to lock your capital away for 6 months, a year, maybe 5 years. In exchange for sacrificing your liquidity, the bank guarantees a fixed interest rate for the entire term. This is crucial when we talk about the yield curve.
How so?
Well, high-yield savings accounts have variable rates. If the Fed cuts rates tomorrow, your HYSA yield will drop. But if you are locked into a 5% CD, the bank must pay you 5% for the duration of the contract, regardless of what the broader economy does.
But the trapdoor there is the penalty. I see people get lured in by a CD paying 0.25% more than a liquid account, and they lock up their emergency fund, and then 3 months later the transmission in their car explodes.
And if they try to pull that money out of the CD early, the bank assesses a harsh early withdrawal penalty. Often, the penalty wipes out all the interest earned, and in some structures, it can actually bite into the principal. You never, ever put an emergency fund into a CD. You only use a CD for capital with a highly specific, known future deployment date.
This analysis leads to a glaring psychological contradiction. The tools exist. They are insured by the federal government. The math proves they generate thousands of dollars in passive income. Yet the vast majority of deposits in the United States remain trapped in legacy banks earning zero. It really exposes a massive blind spot in behavioral finance.
It does.
We are obsessed with micro-optimizations, but we just ignore the macro leaks.
This is the ultimate manifestation of the coffee fallacy.
The coffee fallacy. Every personal finance guru on the internet builds their entire brand around telling people to stop buying $5 lattes. They induce incredible guilt over minor discretionary purchases.
Oh, completely.
People will spend 20 minutes clipping digital coupons to save $4 on laundry detergent. They will drive an extra 10 minutes out of their way to save 5 cents a gallon on gasoline.
And the reason for that is the human brain is wired to feel the pain of a visible transaction. When you hand a barista a $5 bill or watch your credit card balance tick up by $5, your brain registers a loss of resources. It triggers an immediate emotional response.
But these exact same people who are hyper-optimizing their grocery bill will let $50,000 sit in an account earning 0.38% for a decade. To equal the $4,800 lost in our earlier example, you would have to buy $965 coffees. That is almost 3 lattes a day every single day of the year.
The disproportion is staggering. The reason we ignore the $4,800 loss is because it requires an understanding of opportunity cost. And the human brain is terrible at processing opportunity cost.
Because opportunity cost isn't a line item on your bank statement, it is phantom money.
Exactly. Let's define it purely. Opportunity cost is the value of the alternative you forego when you make a decision. By choosing to stay at the legacy bank, the cost is the 4% yield you abandoned.
But because the legacy bank doesn't send you a monthly invoice that says, fee for staying with us, $400, you don't feel the pain. It's an invisible absence of wealth.
And if legacy banks actually had to charge depositors a visible fee to maintain that spread, there would be riots. Millions of accounts would be closed overnight. But because the loss is framed as unearned interest rather than a withdrawn fee, people remain entirely passive.
And the true devastation of this opportunity cost is really revealed when you factor in compounding over a decade. It isn't just that you lose $4,800 in year one. In year two, you lose the interest that the $4,800 would have generated.
Yep. If you let a $50,000 balance sit at 0.38% for 10 years, it grows to roughly $51,900. If you place it in a 4% account and let it compound, it grows to over $74,000. You're talking about a $22,000 delta over a decade purely from the mathematical force of compounding.
$22,000. I mean, that is a down payment on a house. That is a year of college tuition, vaporized simply because we don't perceive the invisible loss.
It's sad, really.
But if the math is this irrefutable and the safety is absolute, there has to be a structural barrier keeping people paralyzed. What is the emotional anchor holding trillions of dollars in these legacy institutions?
The anchor is customer inertia, driven by misplaced loyalty and perceived switching costs.
Loyalty to a multinational financial conglomerate. It is absurd. We are fiercely loyal to our families, our local sports teams, maybe a specific brand of shoes. But why do we feel loyalty to a bank that views us entirely as an algorithmic data point?
It often stems from generational inertia. We inherit our banking habits. A massive percentage of adults still use the exact same legacy bank their parents took them to when they were 12 years old to open a passbook savings account. It feels familiar. It's deeply embedded in their routine.
There is also the geographic comfort. Even if you do all your banking on your phone and haven't spoken to a human teller since, like 2018, driving past the physical branch of your bank on your way to the grocery store provides a subconscious sense of security. Like, my money is in that building.
Sure, but the strongest force is the perceived inconvenience of switching. Customer inertia is the tendency to remain with a suboptimal provider because the mental friction of changing feels overwhelming. People think about moving banks and they imagine a logistical nightmare.
Oh, totally.
They picture spending a Saturday afternoon on hold with customer service, filling out endless digital forms, missing a mortgage payment because an auto draft failed, and having to hunt down their HR department to update their direct deposit.
The brain categorizes it as a high-stress administrative task, so it just indefinitely delays it. I'll look into a high-yield account next month, and next month becomes next year.
What depositors need to realize is that legacy banks do not view customer inertia as an unfortunate side effect. They view it as a primary profit center.
A profit center?
Yeah. They hire armies of quantitative analysts to model exactly how low they can drop interest rates before the friction of moving finally outweighs the inertia of staying. They know exactly how lazy their deposit base is. They monetize your procrastination.
They're literally banking on your laziness. The rates aren't a secret. The 0.38% is published on their website right next to the checking account login. The 4.5% yields at online competitors are plastered all over the internet.
Right.
The asymmetry of information is gone. The banks are just relying on the fact that you won't do anything about it.
Which is why awareness isn't enough. We have to operationalize the escape. If you recognize you're trapped by inertia, you need a methodical framework to move your capital safely and permanently.
Let's build that framework. Our sources provide a definitive checklist. Before anyone moves a single dollar out of their legacy bank, there are 5 non-negotiable questions they must ask about the new institution. This is how you navigate the digital banking landscape without stepping on a landmine. So what is the first hurdle?
The first question is the absolute bedrock. Is the institution FDIC or NCUA insured? We spend time on this, but It cannot be overstated. You do not deposit capital into an uninsured fintech platform simply because they offer a 7% yield.
Never.
You verify the insurance. You look for the FDIC logo, and if you are skeptical, you go to the FDIC's official bank find database and type in the institution's name to ensure they are legally covered.
Binary and essential. Zero exceptions. What is question number 2?
Is the advertised APY variable across the board, or is it a temporary promotional rate?
Oh, the bait and switch. This is a classic marketing tactic.
Yeah.
You see a massive banner ad promising 5.5%. It looks like the best deal on the market. But buried in the fine print, it dictates that the 5.5% only applies to the first 3 months or the first $10,000, after which the rate plummets to 0.5%.
It's a deliberate strategy to capture your capital, knowing that once you move it, customer inertia will pick in again, and you won't bother moving it a second time when the rate drops. You want a structurally competitive variable rate, not a short-term teaser. You want a bank whose entire business model is built on maintaining high yields, not tricking you into the door.
Question 3 targets the phantom money concept again.
Yes. Are there monthly maintenance fees?
Because if a digital bank is offering a high yield, but charging a $25 monthly maintenance fee, they're entirely defeating the purpose of their own model. The reason they can offer the yield is because they don't have overhead. If they are charging you overhead fees, they are double dipping.
Exactly. A $25 monthly fee is $300 a year. If you have a $10,000 emergency fund earning 4%, it generates $400 in interest. But after the fee, your net yield is $100. You effectively drop your APY back to 1%. You must explicitly look for accounts with 0 monthly maintenance fees.
Got it. Question 4.
Is there a minimum balance requirement?
This is how banks tier their depositor base. They might advertise a 4.5% APY, but the fine print requires a minimum ongoing balance of $25,000. If you drop to $24,000 to pay for a new roof, the entire balance gets downgraded to a 1% yield. Or worse, they start hitting you with penalty fees.
Yeah, you need a high-yield account that respects your actual liquidity reality. There are plenty of top-tier online banks that offer their premium yield with 0 minimum balance requirements or a purely nominal requirement like $1. You shouldn't be penalized for actually using your emergency fund for an emergency.
And the final question on the checklist.
Can you easily transfer money between your checking account and this new savings account without unnecessary delays?
This is the operational stress test. Let's say my HVAC system dies in the middle of a heat wave. The repair company needs $5,000. My money is in the digital high-yield account. I initiate a transfer to my local checking account. How long does it take for that capital to clear the automated clearinghouse, the ACH network, and become spendable?
Industry standard is 1 to 3 business days. Some advanced digital platforms have integrated with faster payment rails and can execute same-day or next-day transfers. But you have to read the institution's funds availability policy.
Because if they hold it.
Right. If a bank imposes arbitrary 5 to 7 day holding periods on outbound transfers, it fundamentally compromises the utility of your emergency fund. You cannot wait a week to pay a mechanic.
Once you run a prospective bank through this 5-question gauntlet confirming insurance, avoiding teaser rates, eliminating fees, dropping minimum balances, and ensuring transfer speed, you have found the right vehicle. But there is one final step, and it is entirely behavioral. How do we ensure we actually use this vehicle effectively?
We use the automation system employed by highly financially successful families. We remove willpower from the equation entirely.
Willpower is a heavily depleting resource. I mean, if your financial strategy relies on you consciously logging into your banking app on the 15th of every month, reviewing your budget, and manually deciding how much money to transfer to savings, the system will eventually fail. You will have a stressful week at work, or you will justify buying a new gadget instead, and the transfer simply won't happen.
The automation system solves this by front-loading the decision. You set up the architecture once. Your income continues to land directly in your operational checking account. You pay your fixed monthly bills out of that account. Then you determine your baseline operating threshold.
So let's say you need exactly $4,000 a month to cover all expenses and provide a comfortable discretionary buffer.
You set a rule in the banking software.
An automated recurring rule.
Yes. On a specific date, say 3 days after your primary paycheck clears, every single dollar in the checking account above that $4,000 threshold is automatically swept into the high-yield savings account.
It is an elegant use of technology to weaponize customer inertia. You make the painful, disciplined decision exactly one time on a Tuesday evening. From that point forward, the system builds your wealth in the background. Yep. The 4% yield is constantly capturing new capital without you lifting a finger. It is actually harder to stop the automation than it is to let it run.
This automation creates a firewall between your spending capital and your wealth-building capital, and it perfectly encapsulates the overarching philosophy of this deep dive. Financial optimization is not solely an offensive game.
We spend so much energy on the offense. We stress about negotiating a higher salary, grinding out a side hustle on the weekends, hunting for the perfect stock to buy at the bottom of the market, or trying to time real estate cycles. We exhaust ourselves trying to increase the top-line inflow of capital.
But wealth is equally built through defensive optimization. It's built by walking the perimeter of your financial life and plugging the silent, invisible leaks in the hall.
The profound irony of everything we have discussed is that the single highest return on investment move the average person can make right now requires zero market risk. You don't need to hire a wealth manager. You don't need to learn options trading. You simply take the capital you have already bled for and you move it out of a hostile environment into a structural environment that respects its value.
The spread between 0.38% and 4.5% is the difference between treading water while inflation pulls you under and actually building a self-replenishing financial moat.
Our sources distill this down to a brilliant, unassailable truth. Your paycheck already works hard enough. Your savings should too. Stop letting multi-billion-dollar institutions leverage your labor to generate outsized returns for their shareholders while handing you pennies.
And if this discussion has revealed a massive blind spot in your banking strategy, it should prompt a broader internal audit. Customer inertia is not contained to your savings account. It infects every passive financial contract you hold.
It's a systemic behavioral flaw.
So the question you must ask yourself today is, what else is hiding? What auto-renewing car insurance policy have you blindly paid for 5 years without checking competitors?
Oh, that's a good one.
What software subscriptions are quietly siphoning $50 a month from your operational checking? What legacy investment accounts are charging 1.5% expense ratios simply because you haven't bothered to roll them over? The bank account is the most mathematically devastating example, but inertia is everywhere.
Your greatest financial asset isn't just your capital, it's your attention. It might be time to stop leaving it on the park bench.